Okay, let's continue on with our processes of financial management. Last video we looked at the start of planning and implementing, which related to financial needs and budgets. And now we'll continue on with the remaining three elements of planning and implementing, which are record systems, financial risks, and financial controls. Remembering that these are all processes that a financial manager would need to go through to ensure the long-term success of the business. So budgeting, setting budgets, financial needs, assessing what the financial needs of the business are in the long term to achieve success. Okay, now we're going to have a look at record systems. So a business must implement clear and regular systems for recording financial accounts and producing cash flow statements, income statements, and balance sheets. So what we spoke about at the very start of the whole unit of work on finance, those three key financial statements. So cash flow statement measuring cash in, cash out on a weekly, monthly, quarterly, yearly basis. Yeah, income statement ultimately measuring the net profit of the business, but sales less cost of goods sold giving you gross profit, and then the gross profit less other expenses leading to the net profit of the business, and then a balance sheet, which is recording the assets and liabilities of the business and the owner's equity. So those are three key parts of record systems, and making sure those record systems are appropriately managed to ensure the long-term success of the business, and to make sure that the business is clear and concise on what those financial metrics are. As it says there, ensuring that data is recorded and is accurate, reliable, efficient, and accessible. And don't forget, for a public company, they have to make sure that those records are accurate and reliable, because legally they must submit those to the Australian Tax Office every year, and they must be signed off by an external auditor. So that's an external accounting firm which must sign those accounts off and say that yes, they have been recorded correctly and all figures on those accounts are accurate. And not only is it for external reviewing purposes, but also internally, management will utilise those figures to make future decisions and current decisions about the business, and to try to ensure that business is successful in the long term. The fourth step in terms of processes of financial management relates to financial risks. Okay, so assessing what the risks are to the business, generally external, but also they could be internal, by identifying and analysing factors, internal and external, that could harm the financial position of that business. So that might include things like interest rate risks. So if that firm has got borrowings via debt finance, so they might have a mortgage, they could have a term loan, they might have an overdraft in the short term, those interest rates may well be variable, so that means they could change or subject to change. And the business must be aware of that potential change, because that's going to impact upon the expense side of the business. Another element that could be a financial risk is if it's a manufacturing type business, the breakdown of machinery, or if machinery is getting old, assessing, okay, do we need to actually replace that machinery? Is it going to need some sort of maintenance that's going to potentially be costly to the business? Because if you're a business if you're thinking about Qantas, they're operating aircraft. If they have an issue with those aircraft, that's a machine that they're really reliant on, or they have a breakdown in other type of machinery, you could be looking at huge expenses to either fix or to replace that machinery, and that could pose a massive financial risk to that business in the short term and the long term. And potentially a company which deals significantly with overseas, a devaluation of the Australian dollar could also be considered to be a significant financial risk for that business. So it's imperative that a business is on top of those potential financial risks, and that they are always considering what might we need to do to ensure those risks don't become too much of an issue. The last element of planning and implementing is financial controls. So that refers to day-to-day adjustments to improve the financial performance of the business in areas such as liquidity and profitability. So liquidity, effectively your current ratio, your current assets divided by your current liabilities. Do we have enough current assets on our balance sheet to match our current liabilities? And in the longer term, profitability of the business. So is there enough sales coming in, less our cost of goods sold, giving us our gross profit, less our other expenses? Are we keeping those other expenses like rent, like electricity? Are we keeping those under control to ensure that we have sufficient profit going forward? And again, remember, if you're a public company such as Qantas, you're answerable to your shareholders, and they're the ones who are going to be complaining if profitability is not as they hoped or as they would expect it to be in the medium to long term. So those controls are financial performance indicators of how well the business is going in terms of its objectives. Those objectives might be short term, and they might be long term. So controlling and staying on top, and coming back to the original part of the course, planning and implementing to make sure that there is liquidity in the short term, that there is profitability in the long term, and how the business goes about that is to remain on top of short-term issues. A blowout, for example, in accounts payable could pose a risk to your liquidity. Long-term, sharp rise in costs in terms of expenses could have an impact on profitability. So staying on top of that to ensure that those financial expenses are under control and the profitability of the business is where the business wants it to be in the long term. Okay, the next video we'll deal with the start of debt and equity financing.